Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Well, good everyone. It's Phil Tarrant here, host of the Smart Property Investment Show. Thanks for joining us. Irrespective of where you're listening to today's podcast, often, and I use my plane trips to tune into podcasts, valuable time, or you're in a car, you're on a train, you're commuting somewhere, or you're cutting the lawns. I hope you find what we chat about today beneficial and help shape the way in which you either think about property or motivate yourself to do more of it. So today, going to go back in time, and often we like to do episodes like this where we get repeat or returning guests into the studio to give us a bit of an update on where they are, how they've been, what they've been up to, and it's still early 2018. A lot of people are still reflecting on the year ahead and what plans they're going to put in place to keep growing their property investment portfolio. Today's guest, Kevin Sum. If you remember, and if you haven't tuned in yet, we had a chat with Kevin 4th of May 2017, so a good sort of 8-9 months ago now. Kevin come on and shared his insights, and I'll read the description from our original chat with Kevin just to give you a bit of an insight into the type of things we discussed. It says Kevin Sum says property investment is a lot like dating, but that by casting a wide net across various Australian markets, investors can increase their chances of happiness by finding the one. There we go. In this episode of the Smart Property Investment Show, he joins Phil Tarrant, that's me, to discuss his thoughts on emotional investment, what he looks for in the right market or the right property market, and his advice to budding investors on how they too can begin their whirlwind romance with property. It's all very romantic. Kevin, how are you going?
Yeah, good, Phil. Thanks for having me back. It's been a while and it's good to catch up again.
Yeah, you're still romancing property?
Yeah, but a lot more cautious.
Yeah.
So, when you're looking for that, your long-term, the one, you tend to be more cautious, make sure that you're making the right move, finding the right properties and stuff.
Okay, so the one for you, so I think it's more than the one. You've got a number of properties in your portfolio.
Yep,
Let's do a quick recap on the depth of exposure you have to Australian property. How many properties in your portfolio?
So I had 9, but since then I've offloaded 2.
Okay.
So now I've got 7. So basically the 2 I offloaded, one was in Sydney. It was a unit. I felt that it's done its job. I don't see that it's going to go crazy anymore. It's just because that it's a unit in like a suburban location in Granville. So that's why I offloaded that. Another one was in Orange. So offloaded that as well. It's made the money and I think it's done its job.
Okay, interesting. So that gives us plenty of things to talk about today. For many people in property, it's a buy and hold strategy. So acquire property, accumulate property, grow a portfolio, and at a point in time pay down the debt, and then you realise the benefit from living on the cash flow. What you've done is you've gone backwards in your portfolio in terms of numbers from 9 to 7. You mentioned Granville. Granville?
Yep, Granville, yes.
Which is in New South Wales, not far from Parramatta. 2 stops from Parramatta, past Harris Park, vibrant area, centre of Sydney. And the other place is Orange, so that's a regional rural property.
Yep.
Orange is 3.5-4 hours from Sydney, straight west,
around that.
past Lithgow, Bathurst Way. Was it a house or a unit?
It's a house in Orange.
Okay. So you've decided to downsize your portfolio.
Correct.
Why? You said you think they've done the job, as in they've grown in value. So you've sold these. What have you done with the cash that you realised from the sale of these properties?
So at this stage, I've been investing in other stuffs like startups.
Okay.
And also at the same time, because it seems to me that the property market, especially in Sydney, is starting to plateau. So I want to keep the cash so that in 2018 or even towards 2019, I want to go again in the Sydney market.
So you're liquid?
Yes.
What are you doing with the money at the moment? Is it sitting in an offset account?
It's sitting in an offset account.
Okay, so let's talk about that dynamic for a second. So for our listeners that aren't familiar with that concept, an offset account is essentially a bank account that's connected to one of your home loans. So what you do is that, say if the debt on the home loan is $200,000 and you have $200,000 sit in your offset, you don't pay any interest on that property. If it's an interest-only loan, you still might be paying some of the principal. That's the case. So that's what you're doing right now. You're
Correct.
Offsetting the debt. So you're getting the double benefit of it. So you're getting the ability to reduce the cash required for you to service your property.
Correct.
And you also get the benefit of having money ready to go.
That's right.
To strike when the opportunity.
Correct.
suits.
So when I see a good deal, then at least I know I've got deposit ready, and I can make a good offer with good terms.
So how much cash do you have sitting in your offset?
400-ish, maybe.
Okay, 400 grand. So it's a good war chest to go out there and purchase property. So the Granville property then, and I remember we spoke about it when we first got together, Kevin, 4th of May, go and check it out. When did you buy the Granville property?
I bought that in 2009.
Okay, 2009, and a two-bedroom unit, was it?
Two-bedroom unit.
Two-bedroom unit.
Yeah.
Two-bedroom unit in Granville, 2009, and you sold it in 2017?
Yes.
Yeah, 27, last year.
Last year, yes.
Yeah. So you held it for 8 odd years.
Yeah.
So what did you pay for it when you
I paid 258.
258.
Yep.
And you sold it for
475.
Okay. You happy with that?
I'm pretty happy. I mean, look, I know that in the Sydney market, there have been properties where, you can basically triple the value in that period of time. But having said that, yes, I bought it for 258, and from basically, I lived in it for a while, and when I started renting it out, I lived in it for around a year. So let's say I started renting it out in 2010, I was getting already $350 rent from day one.
Okay.
So at least I know that I'm positively geared, and I don't have to worry at night thinking what happens if I lose my job or something bad happens to me.
It's good. And the Orange property, when did you purchase that?
Orange property, I couldn't remember the exact date, maybe around 2011 or 12, something like that.
And do you remember what you paid for it?
145, around that.
Okay. And what did you sell it for?
I sold for 180.
180.
Yep.
So you made a bit of money
Not
there.
much, yeah, a little bit,
So when you take into consideration, you bought for 145, you sold for 180,
Mm-hmm.
holding costs for 5 years, so you had to pay the mortgage on that. You
Yep.
obviously had to pay stamp duty
Mm-hmm.
when you purchased it. I don't know what LVA you purchased at. You might have had to pay LMI,
Mm-hmm.
lender's mortgage insurance. And then when you sold it, you had to pay an agent's fees.
Yep, agent's fee, yep,
Yeah.
yep.
So do you think you're square, or you made a bit of money out of it?
I would say Orange property is more or less square.
Okay.
Granville property, obviously, I would make some money on it.
Yeah.
Having said that, the Orange property was a good exercise. Number one, because it doesn't really cost me much to actually hold. I was getting $200 odd every week in rent. And the good thing was that I actually revalued my place, and I got equity out. Back then, I didn't have much money, so that enabled me to purchase other properties from
So
that.
you use it as a tool to leverage you into other properties.
Correct.
Okay, and that's an interesting strategy. And for our listeners who are new to investing, some of these terms might be a little bit confusing, but I guess the important point to make is, Granville over a sort of 5-year, 6-year period went up in value sort of $220,000. So you can't complain about that. Doubled in value.
Yep.
And then when the same scenario, you got to look at your costs to get in: stamp duty, legals, buyer's agency fee potentially, LMI, and the sell cost. You're still ahead of the game for quite some time. So you must be pretty satisfied with the result
I'm
of
pretty
that.
happy. Can't complain.
Whereas Orange is a different situation. You got the holding cost of your mortgage, and you had to hold a $250,000 property for 5 years in mortgages. It's a considerable amount of money.
Exactly.
So it's not, a lot of people think selling properties is when you realise the value in the property, but there is a cost associated with selling property.
Exactly.
And you need to be factoring that in.
Yes,
Yeah.
fully agree.
So what made you choose those two properties within your portfolio as the two to sell?
I look at investing as it's basically a tool to make money, right? So to me, investing in property or shares, or even going to casino, playing, blackjack or whatever, it's the same thing. It's just the level of risk, and also at the same time, the opportunity cost. So I think Granville and Orange, those two properties, they've basically reached their peak. And I was thinking, look, I can keep it there, and maybe in another 5 years' time, it might go up by say 50 grand for Granville, and maybe 30 grand for Orange. But why don't I realize the cash, free up some of my money and also my borrowing capacity to buy something which I can use similar amount of money, or I can use the deposit, but it will make me more money, or I think it will go more in value.
So it's a utility of the money.
Correct.
And that's an interesting point on the Smart Property Investment Show. And I often go on Sky Business, Your Money, Your Call, and you get calls in from visitors, and you got an earpiece in, and the typical question will go along the lines of, hi panel, I'm thinking about investing in X suburb, what do you think?
Yep.
And the standard answer to it is, it depends on your circumstances, but by investing in suburb X, if you invested in suburb Y, would you get better use of your money, greater utility of your money? So what you're talking about is the same scenario. So you've realised the value in your properties, and obviously Orange, you realise a bit of money, but it's essentially neutral. But at a point in time, you've gone, I'll take some money off the table. And the money that I've made in this Granville property, I can probably get greater utility out of that if I put it into another property, and I can realise the growth that I see from that.
That's right.
Okay. And is this a strategy you've thought or been educated on, or is it just something that's come to you quite organically?
It's something which just came up because it was just one day, like I was looking at my portfolio. I mean, generally when you're in the game, you don't really look at it from a big picture. So I was looking at my properties. I was thinking, okay, look, what happened in 2015? How much did I think they were worth? 2016, 2017. Okay, and I was thinking, look, these two, yes, it's gone up like humongously from say like 2009 or whenever I bought the Orange one for the first few years, but then it kind of like stabilized a little bit. So that's when I thought, should I keep it and wait for the slow organic growth, or should I offload it and find something which has a better growth? So say for example the Granville one, I might be able to buy 2 in Brisbane, and the 2 in Brisbane that I buy might make me say like or might go up by say 150k in total. But for the Granville one, I only predict say 50k. So why not offload Granville, which potentially might give me 50k, and put it in maybe Brisbane or wherever, which might potentially give me more than 50k.
Yeah, and potentially also get greater diversification, because you can have 2 properties in different markets in Brisbane or different suburbs. It's a good strategy. Did you find the selling process an easy one, or was it a headache?
Oh no, it was relatively okay. I mean, obviously, it took some time to sell, maybe like a month or so. But yeah, it was relatively okay.
And you used a real estate agent for both of them?
100%, yes.
How did you choose the agent? Did you go through listing presentations, or did you just choose someone to say, sell my property?
Basically, I talked to a few, and in the end, for the Granville one, I chose the one who, no, they didn't sell me the property. They were managing my property at one stage.
Okay.
I was basically just going through sold listings on realestate.com, and I was just seeing, who's getting good results, who's always selling properties or always have properties under contract, and basically what the selling price was.
On the Smart Property Investment Show, we talk a lot about acquisition of properties, the accumulation phase, creating wealth through property. What we're talking about here is part of your property journey, and you're going from accumulation to selling, but you're selling to accumulate for the future. So I'm always quite intrigued at the dynamics of selling, because often it's an overlooked part of property. It's not the real sexy stuff. It's only sexy if you sell for a lot of money and make a shitload of money, right? Did you haggle on commission with the agent when you were selling?
I think the commission they offered was reasonable, so I didn't bother, because I was thinking this way. I could always interview like 10 agents and basically just get them to outbid each other.
Yeah.
But what's the point if it makes them lose incentive to get the best price for me?
Yeah, and that's the important thing.
Yes.
So if you haggle on commission, obviously it decreases the appetite of the agent to sell it, and you might not be getting the best service. So it's a fine line.
Yeah.
And a lot of people make the mistake of choosing the agent that has the cheapest commission because they feel as though they'll pay less money. But if you pay a little bit more commission, but you get 5% more on your sales price, you're a lot better off in the game.
Exactly.
And did you find the agent you work with, before I go there, what sort of marketing did you do on these properties?
Basically, just standard stuff. I think just internet marketing. We didn't do any sexy stuff like putting in rental furniture or anything like that, because in that price point, it's not worth it. For the Granville one, I did put in a tenant first.
Okay.
It's because I kind of thought that property would appeal to investors more than owner-occupiers. For the Orange one, I left it empty because I think it's just the Orange dynamic. There might be some owner-occupiers who would want to buy that property.
And that's really important point for our listeners. So you've presented the property in its best light for the target market most likely to buy it. So did you get that advice from the real estate agent? Did they help you make that decision, or did you say, this is what I think, and they agreed with you?
Basically, this is what I think. I told them.
And they didn't contest it? They said, yeah, you're right there?
Yeah.
So how long did you have someone in the Granville property before you sold it, like a new tenant?
I think the new tenant went in probably a month or so.
Okay. And were they accommodating as part of the sales process? Were they nervous that they were going to get chucked out? Or?
No. Because as part of the strategy, I was thinking, look, if I'm going to appeal to investors, I might as well think from an investor point of view. And I think a lot of investors, they like stability. So basically, I signed a 1-year lease with the tenant, which is kind of risky when you're trying to sell a property because you know that basically homeowners would be out of the market. But I guess that's the risk that I took, and it worked.
And I think for a lot of investors, assurance of immediate cash flow from day dot is very important.
Exactly.
Depending on their serviceability or their ability to their cash flow situation. So did you sell the Granville property to an investor? Do you know?
Yes.
It was. Yeah. And what do you think attracted them to the property or the market?
I think
you're talking about selling because it's the top of the market.
Yes.
So this person's bought the top of the market. What sort of $475,000 is the purchase price? What sort of yield were you selling it at?
They were paying $430 per week. So I would say around 4%-ish, something like that maybe.
And they thought that was a good yield?
For Sydney market, it's reasonable, I think.
Yeah. And were they a local in the area, or were they from out of town, do you think?
I think they lived in the Hills district.
Okay. Did you know if they were a sophisticated investor or was one of their first investments? No idea.
I would think it might be one of their first investments. I was just purely guessing because it seemed that they had to kind of cross-collateralize their existing property for whatever reason, because I was hearing from the agent they kept extending cooling off, and I mean, not that it really bothers me because I'm getting good rent, but like they were saying, they had to value their own property, so that's what made me think maybe they're cross-collateralizing for whatever reason.
And so what was the buying process? Did you list it at 475 and get 475, or did you list it higher and you negotiated down to 475?
It was a range. I think it was from around 470 to 500.
Okay.
And we just got that 475. The first offer was like, I think 465 or something like that.
And would you say no?
Yeah, I said no.
Okay.
Yeah, I counted, I think something like 490 or something, and it just kept going.
So the sale... And you speak to any good real estate agent and they'll say that if a property is priced appropriately for the market, it will always sell.
Yep.
So price appropriately means different things to different people. So if you were thinking that was the range, when did you go, okay, so I'm not going to take 465, I'm okay with 475. What was the catalyst for you to say, yes, that's okay, rather than holding out for another 10 grand? What was your decision-making process?
Basically, it was from day one. That was when I saw two very similar properties on the same street. I think one was on the next block. One sold for 430, bigger than my one, and one sold for 465.
Okay, so you went 475 is pretty good.
Yep.
So you knew the market.
Yep.
Okay, so you were able to make an informed decision and not be greedy.
Yes.
Okay, because a lot of people often make that mistake where people who are selling properties think their property's worth a lot more than what it's worth, and people buying property think the property's worth a lot less than what the person thinks. So
that's right.
The market dictates what something finally goes. By the way, where in Granville's the property? Is it near the station?
Pitt Street.
Okay.
Yeah.
Is it one of those blonde brick sort of type buildings?
Yeah. It's I think it's 15 years old.
Okay.
Yeah. So those blonde ones.
Yeah. There's quite a lot of them out that way. So what would you do different if you were going to sell another property again?
It depends on the circumstances again. If I'm not desperate, then probably I'd do the same thing.
Yeah.
Obviously, if I'm desperate, then it just all comes down to price.
So by desperate, what would make you desperate? Cash flow crunch?
Yeah, let's just say I needed the cash flow and stuff. Then obviously it's going to be reflecting in the price.
And you've gone from 9 to 7. Are you going to go down any further, or you don't need to sell anymore? You don't plan to sell anymore?
No, I don't plan to sell anymore.
Okay. And in terms of moving forward now, what sort of markets are you looking to acquire in now?
At this stage, I'm still looking at Brisbane.
Okay.
Maybe the 250 to 400k market. Well, now it's no more 250 in the places I'm looking at. Probably 3 to 400k market, or maybe in Sydney if I can find something good, like something which is a real bargain. And
a real bargain meaning under market value?
Yes.
At what sort of price point though? The median price in Sydney is sort of nearly $1 million.
I mean, probably $700 to $900 maybe.
Okay. 700-900.
Yeah, 700-900 for a house. I mean, you can still find some out the hills area, like Seven Hills, Quakers Hill, that area.
Yeah. They're good regions, but I guess it comes down to understanding what your objectives are in investing. And if you're looking for cash flow, you're looking at capital growth, everyone's circumstances is different. So 7 properties left in your portfolio. So you're heavy in Queensland now, are you? How many? What's the rest of the 7 properties?
3 in Queensland, 2 in Sydney, and 2 in regional New South Wales.
Okay. And are you happy with the regional properties? Are they performing for you?
Yeah.
Yeah.
I mean, I'm getting the rent. Obviously, you won't get as much capital growth. Or no, actually, like I should rephrase that. It's not that you won't get as much capital growth, but then the capital growth won't be stable. So maybe in 2 years it might double, but then for next 5 years it will stay flat.
Yeah.
So say for example, one of the ones I got in Broken Hill, bought it for 48 grand, bought it for like a year or two. I did a valuation, came back around 100k.
Okay.
But then it's probably still worth 100k. So maybe if I bought in Sydney, like look at my Granville place, it's not even double yet when you look at the percentages.
Yeah, it's a lot of moving parts. What about financing? Are you confident that at a point in time when you want to purchase a new property that you'll be able to secure finance from the bank? A lot of investors are struggling at the moment in terms of increased serviceability. The way in which lenders are viewing investors has changed quite a lot, and appetite for borrowing over 80% is waning. Okay to get finance? No problems there?
No problems, yeah. Because all my properties when I bought it, it's either 80% or less. But that was the price, like that was when I bought it.
Yeah.
And I guess because I've offloaded some of the properties, I guess the new properties that I would be looking at, unless they're a really good bargain, I would be looking at a okay rental return so that I can sleep at night. High rental return means more serviceability, so that would help. So for me, it's not really much of an issue because of the market I'm playing in.
So we met on the 4th of May last year, so it's early 2018 now, so eight-ish months ago. When we chat in a year's time, and we'll get you back in the studio, what would you say to your future self in a year's time? What will your portfolio look like, and what will you be doing?
In a year's time, it's going to be interesting because this year probably is more of a wait and see year. It's not like a go crazy year for me. So in a year's time, maybe I would get another property, or maybe I would stay the same.
Okay, and there's nothing wrong with that.
Yeah,
you've got. Do you think that you're getting good value for your $400,000 sitting in an offset? Obviously, if that's sitting against a interest rate of 4%, you're doing quite well out of it. You'd struggle to get that same return on your money if you put it in some sort of other investment vehicle, unless it's very risky, like Bitcoin.
Exactly.
So are you happy with that strategy? You don't think you should park that money somewhere else and try and realise a better yield so you can pay the debt off your mortgage?
Well, I guess it depends on what opportunities are out there. There's always, say for example, if I put the 400k in Bitcoin a year ago, I would be laughing now.
Yeah.
I don't know how much it's worth now, 400k. Probably
There's a lot of Bitcoin.
A lot of Bitcoins, yeah, a lot of them.
You would have 500% times it, right?
Exactly.
Yeah.
So it depends on the opportunity. If the right opportunity comes up, then why not? Because at the end of the day, it's opportunity cost. So my opportunity cost now is that I'm not putting it in a growth vehicle, such as like your shares or properties or even like business ventures and stuff like that. I'm parking it to wait for the correct opportunity. But having said that, it'll probably just be 1 year, because after 1 year, I think I'll have to do something either way.
Do you get itchy feet? Like, do you need to be doing something to keep yourself happy?
Well, you want to. Once you get into the game, you actually can't really stop. So I'm still looking in the market actively. Obviously, I haven't been going to a lot of open houses lately, but every night I would still spend some time to go online and see how the market's going in different areas. But at the same time, I guess because of all the changes and stuff, I want to see what happens in the next few months first.
And that's wise counsel for, I think, a lot of our listeners. Don't rush into anything right now. It's I think it's a market in transition. Obviously, there's markets all over Australia which are different to each other, but it is an evolving market. Interest rates, we don't know yet what's happening. Our Reserve Bank hasn't met yet this year to actually determine the direction of interest rates, but there's one thing you can guarantee: at a point in time, interest rates are going to start going up. Whether it will stay steady for the immediate future, I'm not too sure. I'm not an economist, so I'm not going to offer that advice. There's a lot of people smarter than me and above my pay grade that can give you that sort of insights. But I think the message for investors is it's okay to take it slow. Keep your powder dry.
Exactly.
Strike when the iron is hot. I don't know what do you call those things? What do we call them? Anyway, doesn't matter.
Yeah.
I'm trying to think of the English phrase for those type of scenarios. But that's cool, Kevin. So you happy at the moment?
Yeah, I'm pretty happy at the moment. Yeah. I guess like the main thing that I always remind myself is, yes, keep looking, yes, do your research, but at the same time, don't overanalyze.
That's fine. Yeah, metaphors is what they are. Was the word I was thinking for. Yeah. Sam's nodding his head. Took me a while. Yeah, don't overanalyze. And I guess to bookend the chat, I read the description from the podcast when we spoke on the 4th of May. Go and check it out about finding the perfect match, right? So you're in the market right now. You're out there actively dating, trying to find the right property. When do you know you found the right property for your circumstance? Your circumstance is going to be unique to yourself, but when do you know that you've found the one?
Basically, when it ticks all the boxes.
Okay.
So
what are your boxes?
Okay, so it might be, say for example, if I'm looking in one of the areas I'm looking in is around Ipswich area, so Redbank Plains, Springfield, in Brisbane, or even in Logan if the correct property comes up. But it's so hard in Logan now.
Yeah.
It might be, look, it's got development potential, which means it's got the good sized land, it's got the good frontages. Or maybe it might be a Queenslander, and downstairs level might be legal height, which is 2.3 meters, and I can put 2 families in. Those are the boxes that I would want to tick.
So it's not capital growth; it's not just cash flow or yield. It's something
both.
with a bit of an X factor.
Yeah,
both and something
exactly.
good. Yeah, it's what everyone's looking for.
Exactly.
So good luck. I think you're looking for the one that everyone's looking for. So,
yep. It's going to be hard,
and it's competitive. Do you use buyer's agent? You do it yourself?
Nah, do it myself.
Do it yourself.
Yeah.
Why do you do it yourself?
I think it's part of the journey. It's about enjoying the journey. So, and I think I get more control by doing it myself.
Okay, that's fair. So you got to be happy.
Yeah, it makes me happy. Yeah. Can go off for a trip, every now and then. Go off for a holiday.
That's good. And your one piece of advice for investors in today's market, what would it be?
I guess it's just, as I said before, don't overanalyze. Keep looking. Make sure you buy with your head, not your heart. But yeah, it's always back to that. Once you think you've found a property and you've done the research and it makes sense, just go for it. Don't waste your time.
Sound advice. Kevin, appreciate your time.
Thank you.
Remember to check out smartpropertyinvestment.com.au. If you don't subscribe to our morning market intelligence newsletter, so you can be the first to know what's going on in this world of property and the economy, you can subscribe smartpropertyinvestment.com.au/subscribe. If you like social media and that's where you get your info, just search for Smart Property HQ. You'll track us down there and like us, follow us, do all that sort of stuff. Any questions for myself or the team or for Kevin about his property journey, I'm sure he'd be happy to answer them. Email us editor@smartpropertyinvestment.com.au. And if you'd like to come on the show, get in touch. Kevin, it's not that scary, is it? It's pretty easy.
It's pretty easy, pretty good.
Yeah.
Quite enjoyed it.
Yeah, good. It's we like to chat to investors and hear everyone's stories. So the invitation is there, and the Smart Property Investment community is large now. Tens and tens of thousands of people are tuning into the Smart Property Investment Show. So it's good to be part of it, and I do appreciate you spending your time to join us as we go down this path of creating wealth through property. So we'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.